honorable professors, and my dear friends. It gives me immense pleasure to welcome you all on behalf of our Commerce Department and Team Udyojak. I am your host for today's webinar on stock markets. Today's session is an interaction on parameters to select the gems from the stock mines by our respected guest, Mr. Yogesh Narwekar, sir, the founder of FINNICS Financial Services. Yogesh sir's journey is an example of hard work and passion. He worked for 20 years in the field of engineering. However, that did not stop him from realizing his passion in the field of personal finance. As we say, hard work is the stepping stone for success. Yogesh sir's relentless efforts and persistence of more than 6 years have made Phoenix Company a huge success. Phoenix Financial Services, established in the year 2015, is a professional solution provider in the field of personal financial consulting. Phoenix Company aims to help their clients achieve financial well-being and manage their financial resources. Phoenix Company provides advice in the areas such as tax planning, insurance planning, mutual funds, reti- retirement planning, and many more. About more than 6 years of experience and 75 award wins, Phoenix Company at present serves more than 350 happy families, and the number is growing by the day. In today's session, we would be discussing about the elements to be considered while investing in the stock markets and the various other aspects in the stock mines. Now I would like to request our respected sir to start the seminar.
Hello, good morning, everybody, and thank you for this wonderful introduction. I see many new names over there as compared to whom attended the last session, rather last year. Only Pranav or Jignasa is there, whom I remember. Other than that, everybody else are new batch, I believe. So, good morning, everybody. Hope all of you are safe and studying from your home. And welcome to you all for this session on selecting parameters to select the gems from the stock mine. As the subject shows, it is a parameter to select the stock. So I'm not going to give you any tip over here. Rather, it is very difficult to work on the tip and be successful. So it is just to show you if at all anybody wants to go the stock market way through direct stock purchases, then what are the parameters that he or she should check out while purchasing or selecting a stock. So before starting this my presentation, I would like to know this session to be interactive so that it will be interesting for you as well as me. So before starting, I would like to know how many of you have a Demat account. You can reply in the chat. So in last 2 years, there is sudden increase or in the Demat accounts people have opened, and lot of them are millennials or the new generation which have opened a Demat account. So I would like to know how many of you have opened your Demat accounts. I see Isha is saying yes, Atharva, Pratik, Saili, Vignesh, Vinit, Raj. Oh, the replies are coming fast and all are saying yes. So I believe a lot of you have opened a Demat account and you must be buying the stocks or rather trading the stocks. So what is the difference between buying and trading, that also we will discuss. So a lot of you have opened in last 1 or 2 years. So how many of you have are investing into mutual funds as well? Are anybody of you are investing in mutual funds? No replies. Saurabh is saying yes. Akshata is saying yes. Rather too few, I believe. So not yet, but want to. Janavi Juvekar is saying planning to. Good. Anybody else? No. So I believe those of you who have opened demat accounts are specifically for stock buying and selling, and many few have started to invest into mutual funds. So good. So I will start sharing my screen, and it is a small presentation, not a big one. And I will try to give examples as well, so that it will be helpful for you to understand the terms. So let us start with the presentation. Can you see my screen?
Yes, sir.
Yeah. Okay. So first of all, we will go through the learning objectives. Actually, I am not able to see the chat screen. So if there is any question, just coordinator, just let me know so that I will try to answer it. If there are too many of the questions, then maybe we can club it and answer it at the end of the session through a question and answer. So
Okay, sir.
the today's learning objectives are what is capital market? So what is equity? When we say equity, so what is equity actually? What are the advantages and disadvantages of investing into capital markets? Then we will come to the main subject of the today's presentation. That is, what are the parameters that one should look out for while selecting any stock? So there are 5-6 basic parameters which I have shortlisted. That is earnings per share, price to equity, return on capital, then return on equity, debt to equity, interest coverage ratio, and then the last aspect, which is very, very important, but many times it is neglected, that is behavioral aspects of investing into equity asset class. So what do experts say, and how the investor behavior changes the returns that he get, or the performance that his stock portfolio makes, how that is differentiated because of the behavioral aspects. So that we will look into it. So starting with the first, so what is capital market? So capital market refers to the places where savings and investments are moved from suppliers of capital to those who need the capital. So what does that mean? So we will take an example. So I want to start a business, a restaurant business, for example, and I have got some money. Say I got 80 rupees, but I am falling short of 20 rupees. So I go to Pranav, who is having the money, and he also wants to start a business per se, but he doesn't have that much of a capital. He has got ideas, so he has got money. So I borrow 20 rupees from him. So what happens? I've got 80 rupees of mine, plus I got 20 rupees from Pranav, and we started a business, or a restaurant business, through with that 100 rupees. So that 100 rupees becomes our capital. So that is how the capital market works. So there are businessmen who have got the money, who have got the ideas, and they also borrow some money from the investors. And that's how the business is started. So capital market refers to the places where savings and investments are moved from suppliers of capital. Who are suppliers of capital? The investors. And those who need the capital. That is the businessmen who run the business. Now the capital market consists of two markets. One is primary market and the other is secondary market. So what is primary market? All of you must have heard the IPOs, initial public offerings, which hit the market in last 1 year. Lot of money is raised through initial public offering, that is called as IPOs. So that is nothing but primary market. So what is primary? Where new securities are issued and sold. The non-listed businesses are listed on the stock exchanges, and their securities or the shares are issued to the general public first time. So that is called as a primary market. And then what is secondary market? It is secondary market where already issued securities are traded between the investors. Once the stock is listed, then the buying and selling happens between the investors. It is not between the promoter and the investor, but it is between the investors. So that is called as secondary market. Now the most common type of capital markets are stock market, bond market, and the third is currency or foreign exchange market, which we are not going to talk about bond and currency market. The main subject of today's discussion is stock market. So we will be discussing about the capital markets. Bond market means where the money is raised through debt. The money is lent to a business. So that is what when it is called as bond market. So what is equity for an investor? So from an investor perspective, equity means ownership of the businesses. It is very important to understand that equity means ownership. You are owning the business. When you are buying a share of any particular company, you are a part owner of that business. So when you look at this equity from this perspective, your thinking will change. It is not only buying a stock at 100 rupees and selling tomorrow at 120 rupees. That is not the thing that you must think of. It is when you are buying any particular stock, think about you are buying that businesses. So you become a part owner of that business. And so what does equity allows? Equity allows a company to give investors a share of the business for which they earn returns as the business grows. So as the business grows, what happens? The stock price of that company increases. And when that stock price increases, the value of your investment increases. So you get more returns. And how the investor earns the returns in equity investment? There are two ways. One is dividends. When any business does any profit and that profit is paid back to the investors in the form of dividends. So you must have heard TCS declaring 120% dividend or Reliance declaring a 60% dividend or 50% dividend. Now it is a quarterly result season. So third quarter ka results are started coming out. Just day before yesterday, TCS and Infosys announced their results. I think even yesterday, HDFC Bank also announced the results. And while announcing the result based on their performance, the company announces dividends. Whatever the profit they have made, they distributes part of that profit to the investors in the form of a dividend. So that is the one way of earning from the equity investments. And the second is capital appreciation. So you must have heard after the Zomato share. So the recent examples I will give you is Zomato. The Zomato share I think was announced at a price band between 90 rupees. And when it listed, it got listed at the 132 rupees or something. It went to 160 also. So what happened? The person who had invested at 90 rupees into a stock, his value appreciated to 160 rupees. So if he had bought one share of at 90 rupees, that one share went to 160, so he got a 70 rupees ka appreciation. So that are the two ways in which a equity investor gets benefited from the investment into equity market. So what are the advantages of the equity investing? Why people should invest into equity investing and how they are benefited? So first and foremost is as an equity investor, you enjoy the ownership of the company. So just think of it with a small investment of even 2,500 rupees, you can own one share of Reliance, or maybe at 3,500 or 4,000 rupees, you can own one share of TCS. So with that one share of TCS, you are becoming a part owner of that company. So that is the advantage. So even without starting your own business, you can partly own a company through shares. Earnings in the form of profit sharing through dividends. If the business make profits, then that profit is shared with the investors in the form of a dividend. And the second is returns in the form of capital appreciation. That what we just saw, second and third point. So you also get, apart from the dividends, you also get returns in the form of capital appreciation over a period of time. Then fourth is ability to generate the returns that are higher than inflation. So I'll again give a small example. We started with the restaurant business. So I had 80 rupees. I took 20 rupees. I went to Pranav and asked for him to give me another 20 rupees. He had capital, but he was very, he was not confident whether I will be successful in doing the business or not. So he went to, but he had the 20 rupees. So he went to bank and he opened a FD on FD right now, what is the interest rate that you get? Around 5-6%. So that 20 rupees he invested at around 6% in the bank. Now bank had got the money and bank lent it to me at a higher rate of interest. Obviously, to get benefited from that investment, they gave 6% rate of interest to Pranav, but they charged me around 10 to 12%. So they gave me a loan of 20 rupees at around 10 to 12%. Now, to benefit from that investment, whatever loan I have taken, if I have taken a loan of at around 10 to 12%, then my business should grow at more than 10 to 12%. Then only I will be able to give the money back to the bank. So equity markets generally give returns higher than inflation. So you must have heard the GDP of India. GDP of India is around 8 to 9%. It was growing at around 8 to 9. Before Corona, it went down to 5-6%. So what is that GDP? That is normal GDP. In that, you add the inflation at around 6%. Then you get a nominal GDP. The nominal GDP of India is around 11 to 12%. If that is growing at 11 to 12%, the businesses, it means businesses are growing at 11 to 12% or more than that. So in equity markets, it has got the ability to generate the returns that are higher than inflation. So that is why it is said the debt markets or the FDs that give you returns which are in line with the inflation, but the equity returns are always more than the inflation. So they actually give you real rate of return. Then what is the fifth advantage? That is a limited liability. So what is the liability? So if Pranav has given me 20 rupees and tomorrow the business doesn't work, then what will be his liability? His liability will be limited to the 20 rupees. Whatever investment he has done in the business, that will be only his liability, not more than that. Whatever the debts I have taken, that won't be have to be paid by the Pranav. His liability will only be limited to 20 rupees. Then sixth benefit of equity investment is tax benefits. How the tax benefits are given for the equity investors? So if you invest into a bank FD, then you must be knowing that bank FDs interest are taxable. And how that is taxable? It is added to your income. All of you are commerce students, so I believe you must be knowing the taxation part of the investments. So when you are investing into a bank FD, whatever interest that you get, first thing is you don't get interest higher than the inflation. So the interest rate is in line with the inflation rate, or rather less than the inflation or just above the inflation. And on that, you have to pay the income tax. So that is in the range of around 10 to 30% based on your income slab. As against that, if you invest into equity, the long-term capital gain is taxed at 10% over and above 1 lakh. So for the first 1 lakh benefit, you are not taxed, and beyond 1 lakh, it is only 10%. So that is also an advantage of equity investing. So you have less tax. Then seventh advantage is liquidity. So what is liquidity? If you sell the stock, within 3 days, the money gets credited to your bank account. So as an asset class, it has got a very high liquidity. Just think against that, think of a real estate. If you are investing into a real estate and if you want the money, then you need to find a buyer. Then you need to do an agreement, and then the selling happens, and after that you get the money. So the period is very long. But as against that, if it is a financial asset into equity, the liquidity is very high. Within 3 to 4 days, you get the money back in your bank account. Then 8 advantages, equity investing helps in economic development of the nation. So as we invest into equity, the stocks are traded. So by that, and the company produces the goods, those are sold in the market. The profit is generated, which is shared with the investors, and thereby the companies, corporates pay the taxes, which help in infrastructure development, and thereby the economic development of the nation happens. And last but not the least, it is a very well regulated structure. Equity markets have a well regulated structure. All of you must be knowing who is the regulator of the equity markets. Can I get some answers? You can write in the chat box and maybe coordinator can tell me. Who is the regulator of the equity markets?